Well, good day there, Wealth Press subscribers, viewers, traders, and investors. It's time for another midweek conversation about markets. And this week, I'm joined by Adam Sarhan. Adam?
Hey, James, how are you?
Great, thanks. How are you doing?
Excellent.
Adam, yesterday we saw the Fed launch a $1.2 billion stimulus program, but it's actually quite a bit more than that if you read the fine print, because they're going to reinvest the proceeds from the coupons into more treasuries and more mortgage-backed securities. And in fact, they're sounds like they're reestablishing some of the special purpose corporate vehicles. And the message is clear to traders and the market that we have a new floor on the market and another boost of liquidity to kick off 2021. So in the context of that, what do you see as the message that we should interpret from the Fed in our attitude towards trading in 2021?
Yeah, I think, James, that's a really good point, if not the most important point for the entire year going forward. With COVID cases going up, with COVID cases going down, we've seen one constant, it's been the Fed printing money and easy money, dovish stance, so on and so forth. And the Fed meeting, and Powell came out afterwards in the press conference, and like you said, in the fine print, made it abundantly clear the easy money is here to stay for the foreseeable future. Remember, the Fed has a dual mandate. They want to keep unemployment, and then they want to make sure inflation stays near 2%. And Powell made it very clear in the fine print saying, hey, inflation's not at 2%, and we're going to keep policy accommodative, which is a fancy way or euphemism for easy money, and we're going to keep printing like crazy until we get inflation higher. And if Main Street slows down again, enter any reason you want, we're going to pump more money into the system. So not only are we going to continue pumping money in the system, but if the market corrects, or if Main Street, get another recession or a slowdown in economic data, we're going to pump even more money into the system. So from my standpoint, that's a message that can be heard all around the world to traders and investors, that the easy money part, the music is, continues to play. Think of the game of musical chairs, right? So as long as the market's responding well to the Fed, it's like game of musical chairs. Everyone's fine. They're dancing. They're having a good time. It's what you really have to worry about is when the music ends, meaning when the market stops reacting well to all this easy money. And by the way, it's not just the Fed. It's other central banks all over the world that are doing the exact same thing. So you've got a massive, concerted, coordinated global event by global central banks to stimulate, quote unquote, asset prices, which basically means the stock market.
Sure. Yeah. Just last week, while the Dow and the S&P were selling off, the European Central Bank announced 600 billion euros in a one-time stimulus move, but clearly leaving the door open for continuous one-time injections. So I was surprised that the market was selling off, but then not so much, because North American markets don't really pay that much attention to what's going on in Europe, because it is all about the Fed. And clearly the European Central Bank is sort of slightly preempting the Fed, but they obviously knew that the Fed, we can fire this bazooka safely because the Fed's going to come up behind us and blast one 10 times the size to take all the heat off.
Yes, seriously.
I have this sort of strange sort of attempt going to understand this modern monetary theory attitude among the central bankers, because, okay, you keep printing money and you keep injecting it, and you say that you're chasing this 2% inflation. Is it 2% per month, per year? Is it a 2% annualized thing? Because, just looking at the debt, the U.S. sovereign debt is 27 trillion. And so by committing to $1.4 trillion in an underlying program, with the door open for $900 billion to $3 trillion, event-related stimulus packages, right, they are achieving monetary inflation at a rate that very much exceeds 2% per year.
Yeah.
And
yep. Go
they
ahead.
are saying that they don't see that in price inflation, and therefore there's no inflation. And to me, that's like, well, wait a sec. You've created an entire world of artificial synthetic assets for this artificial synthetic money to go chase. So it doesn't have to chase real economic products like the money used to have to do in order to go to work. Now the money can go to work in esoteric things like derivatives and securitized instruments that are or insurance policies on securitized instruments, or any of these things. And it's like, well, I don't understand what is the purpose of targeting 2% inflation. What is the purpose?
Yeah, I mean, James, you're bringing up fantastic points here. And the purpose, to answer the question, is to keep the people on the Ferris wheel, keep the wheel turning. Because as long as the stock, and that means the stock market's going up, as long as the stock market continues going up and we don't have a crash in asset prices on stocks, and we don't have a run on the banks, if you will, that panic mode setting in, like we briefly, not even smelled, but there was a hint of it back in March of 2020 when you saw that COVID kind of panic set in. But you really don't have that setting in. You don't have a tremendous amount of bankruptcies. You don't have the panic. You know what I'm talking about, with just sheer panic. So as long as you don't have all of that happening, guess what? Things are quote unquote okay. So essentially what the modern monetary policy, I guess, officials are doing is they're kicking the proverbial can further down the road, hoping that eventually we're going to get growth. If we get growth, economic growth that is, it's going to hopefully make up for the trillions and trillions of dollars of the proverbial hole that we're digging. Because if the economy can grow, then you get more money coming in, and that can help service some of the money that's been going out. The problem with that experiment is, there's no factual data that supports this will work. All we have, it's a big experiment in real time, which, by the way, has been going on since 2008/2009. Everything you're mentioning, the derivatives and the credit and the Schmedit and the meta and all this kind of fun stuff, reminds me very much of what we saw happen in 2006, 7, and 8. And that led to the financial crisis. So what they're doing is, like, look at the last 10, 11 years, right? Since 2008, 2009, you had a situation where the Fed had one, I guess, MO, if you will. And their modus operandi was like, let me just go out there and flood the system with liquidity, and hopefully that'll take care of our problems. Well, Bernanke started that, the former head of the Fed, back in 08 and 09, and that worked. The stock market started going up. And then he passed the buck off. Yellen took over. She continued doing it. And then she passed it off, and Powell's now doing it. And every time the market gets in trouble, you see the Fed come in with, like you said, not one bazooka, but 100 bazookas more of easy money. And guess what? Stocks go right back up. And that's what's known as the Fed put. And that remains a very, very, very powerful force in the market. And we don't know the end of this. And that's really the problem here. Nobody knows how this is going to end.
Yeah. So, I mean, I look at it and I think, well, I'm just going to start squirreling away nuts into the the more conservative investments, because I find that the conservative and reliable investments that have been rising steadily as been primary beneficiaries of the stimulus put, the Fed put, are going to continue to do so in such an environment. Whereas the longer term speculative bets that I've been in the habit of making for most of my life, they don't tend to perform very well in these environments, because people are saying, well, why should I take a risk on a longer term when I can pretty much take zero risk and close my eyes and throw a dart at the board for a week and, swing trade my way to financial security? I mean, the Fed ultimately is undermining the potential for economic growth because they reduce the willingness of the entrepreneurial class to take risks, because it's so much easier and safer to just sit at home and, throw darts at the board. So, like, does it not sort of resonate with the policymakers that, yes, this looks great for the current optics and painting the tape, as it were, but in the real term, in the real sense, that's why we have this vast differentiation between the real economy and the stock market, because the stock market has nothing to do with the real economy anymore.
Yeah, no,
so
it's 100%. Yeah.
Like, this is not a solution. This is kicking the can down the road is actually amplifying the problem, while, yes, placing it into somebody else's problem universe down the road. So, like, what do we do? I mean, at what point does this all sort of resolve itself?
I mean, again, it's fantastic points. I mean, fascinating if you think about it from the practical standpoint, right? I'm later today at 3 o'clock. I'm being pitched by a big institutional investor. They've got $1.5 billion under management. They want me to invest with them into a real estate project that's going to pay 7% a year in quote unquote safe, risk-free money. Nothing is risk-free. We all know that, but that's the mindset. They're almost like blinded by it because people just don't understand that risk is a part of investing. You have risk and you have reward. It's just the other side of the coin. You can't have reward without risk. So what, to your point, what the Fed's doing now, unbeknownst to, really, it's more of like an unintended consequence. It's not their intention, but it could be a byproduct of what they're doing. It's something that Ray Dalio's talking about really big for the last 6 to 12 months or so. And Ray Dalio, for those of you that don't know, is the biggest hedge fund manager in the world. And this guy studied history. And I love what he says. He goes, everything that happens to people is just another one of those, meaning it's happened to someone else at some other time in history. You personally just don't know about it, right? So it's, in other words, you're not the first person to encounter X problem. It's happened at some society, some economy's gone through this kind of situation, so on and so forth. So if you look at central banks and what's happening right now, back in Japan in '89, the Nikkei, their stock market hit an all-time high. And then it just went to that zombie decade, if you will, if not several decades, and it never really recovered. And their central bank is buying their stock market. They're buying ETFs left and right, and they're in a really tough spot. So this has happened before recently. So to your point, what's happening now, how do we get out of it? Nobody knows. Dalio's saying, listen, the decline of empires is because of problems from within most of the time, unless if they're conquered from another empire. But it doesn't look like that's going to happen anytime soon because of the, the economic might and just the way things are militarily, the way things are, or I guess the balance of power, if you will, today with the atom bomb is a little different than it was before. But if you study from an economic standpoint, you're seeing massive trends shifting. And then another major investor, a guy named Jim Rogers, who's George Soros' partner way back when, had a great line. He told me one time, he goes, power follows wealth. And if you look at what's happening now in the Western world, they're taking on a tremendous amount of debt. And that's not good. Well, who's buying all that debt? Where's the wealth shifting to? And you're seeing a massive amount of shift in wealth moving away from where it has been for the last 50 to 100 years. And then eventually the power may shift down the road. So everything that you're addressing are major problems, but they're longer term problems that take decades to unfold. But when the hair that breaks the camel, or the needle that breaks the camel's back, if you will, actually breaks the back, it's just boom, the whole house of cards comes down. But as long as the Fed can kick the can down the road, stocks go up, and then stocks correct a little bit, Fed pumps more money in, and Congress is okay with all this, it's okay for now. But longer term, it's really a bad situation that could unfold here.
You bet. Okay, well, so great. We're basically aligned on this idea that quantitative easing, for want of a better word, I call it quantitative counterfeiting because it's really not backed by anything, and and it gives rise to asset classes which, to me, I look at Bitcoin and I think, well, Bitcoin is the ultimate product of a civilization living in a fantasy. It's like we've taken what used to be a representation of value, a dollar bill, used to be a representation of stored value, gold, which was the result of very much effort combined and energy combined to create something of actual limited tangible inventory on the planet and in the universe. Yeah. So it's logical, at least from where I sit. You look at Bitcoin and you say, well, yes, up to 1/3 of some countries' energy is being directed to the manufacture of Bitcoin. And we had Jim Minard saying yesterday that he thinks that Bitcoin's fundamental value, right, which I just about threw up my cereal when I heard him say that. Fundamental value is should be more like $400,000.
Right.
I thought, how can something that is nothing except the result of a energy-driven algorithmic problem being solved that has no, if all of the power was interrupted in the planet, it would be like you wouldn't have any Bitcoin. Not so the case with gold, not even so with the case of the US dollar. You still have the paper, you still have the gold. But the Bitcoin, there's nothing. There's nothing.
Yeah.
And so, I mean, great. You got this fantasy world, these fantasy people spending fantasy money and creating fantasy wealth, and not understanding that at the end of the day, we're saturating the planet in terms of like the amount of people and the amount of product the planet can produce. We've already exceeded in terms of consumption, the amount of biomass, the energy can reproduce versus the amount we take out for food and other products. So really, we're already in decline if you look at those lines on the timeline. So all of this stuff, while kicking the can down the road, is actually, it's not kicking the can down the road. It's actually just creating the illusion of the problem being moved into the future, but the problem is accelerating in our real time. So my long-winded way of saying, if the inevitable outcome of all of this fantasy economy has got to be a musical chairs kind of stopping of the music, and if you don't have a chair, you're not just standing there without a chair. You're basically ruined. You're ruined. And so my long-winded preamble, what should we be doing as investors who might buy into that idea that this is actually a ruinous path we're on? And yes, you can participate in the bubbles while the bubbles are being blown, but you also have to make a provision for the ending of the music. What does that provision look like?
Yeah, that's a very good point. So my view on what you just said is you're spot on in multiple fronts here. The question becomes is what is your time frame? What is your objective? And what are, and this is plural, what are your goals? Because you can have investment objectives and you can have personal goals, and they could be different. So if your goal is to be retired and have enough money to not have to worry about working again or so on and so forth, that's completely different than if you're 18 years old or 20 years old and you have no money and you're getting started and you're looking to build that nest egg, right? So if you look at Bitcoin itself, and I, for a long time back when it first started, didn't understand it and was of the mindset, this is nonsense, so on and so forth. I've seen firsthand people make a tremendous amount of money along the way. The bubble burst a few years ago, it got crushed, just like what happened to NASDAQ, and then it came roaring back this year, interestingly enough, out of all years in 2020. And you've got to ask yourself, do you want to participate? And are you bullish on this? Can you make money on it? Is there a portion of your portfolio that you want to allocate to something that could be a frothy, it could be bubble, it could be overvalued, whatever word you want to use? Or do you want to just stay away? Remember, the beauty, James, in investing is that there's no right or wrong. There's an infinite number of ways to make money. Your job is just to find one that works for you. So that being said, in other words, just like in business and life, if I want to go become a farmer, I'm free to do so. If I want to become a executive of a CEO, I'm free to do so. So, and clean toilets, I can do that as well. There's no right or wrong as long as you find something that's right for you. So the point that I'm making is that everybody's portfolio is their own. It's your money after all. And the best thing I recommend doing is making sure that your investments are aligned with your goals, and not just your short-term goals, but your intermediate and, more importantly, your long-term goals. Because a lot of people, James, if you look at the way people behave, and that's really important, is that they look at the short-term outcome of said activity, and then they either do more of it or they do less of it. And they don't look at the long-term outcome of that activity. So what's an example of that in real terms? People like to avoid pain and they seek pleasure. So somebody who's got a belly, for example, doesn't like doing the sit-ups. Well, we know in order to lose weight, it's calories in versus calories out. If you want to have a six-pack, do 1,000 sit-ups every day until you get a six-pack. It'll work. Problem is, most people are like, oh, I don't want to do the sit-ups because there's pain associated with it. Instead, they'll go eat the chocolate chip cookie, and there's pleasure associated with that. Short-term pain. Right, or short-term pleasure. Now, if you think about it, though, if you eat the cookie every day, you're getting quote-unquote pleasure, but every day that short-term pleasure adds to what? Long-term pain, because then you're overweight and you've got diabetes, so on and so forth, right? So if
shorter life,
etc. So if you look at anything you do and you ask yourself, simple question is, what are the long-term consequences of that activity? Is it good or bad or pain or pleasure or positive ROI or negative ROI? However you want to word it, it's all the same thing. And you say, okay, forget the short-term pain or pleasure. Let me look at the long-term. And you make your decisions based on the long-term outcomes. You blink your eyes and you fast forward 3 or 5 years, 10 years, and you're in light years, a whole different universe. You're in a much, much better place because you're able to recalibrate your reptile brain, if you will, the subconscious mind, and learn how to make smart money decisions that align you with your longer term goals. So I hope that helps answer the question.
Well, it does and it doesn't. I mean, and this conversation is now veering off into sort of a weird place that doesn't have a lot to do with the market. But so that's my point. If the purpose of investing is to ensure a secure point in your life down the road that is characterized by less risk of not having a house and not having the ability to feed yourself, then to reduce the equation to look at your longer term goals and make smart decisions vis-a-vis your ability to make money, that assumes that this all is going to make sense when you hit that point down the road and you need that money. But what if, and this is the question that I wrestle with, is, well, what if the monetary system what if the rug is going to be yanked out from under us in such a way that it doesn't matter if you have a portfolio that's full of billion-dollar, stocks, those aren't going to be worth anything because there's an alternative narrative,
right,
that's out of our control, that's under the control of people who control things like military organizations and private armies. And, is there, to get to that point, they didn't get there by being socially cooperative. They got there by being predatorily competitive. Right. And so I look at what's going on and I'm thinking, well, this is great. I understand the purpose of the illusion is to create the impression that somebody's got our better interests at heart. And so keep on doing what you're doing. Yeah. Meanwhile, what is really happening is there's preparation underway for a major reduction in population so that the elevated lifestyle to which certain people have become accustomed can be maintained without threat of alternative predatory
whatever
people
happens. Right.
Acting out of desperation. So in that case, maybe, focusing on making a good nest egg is fine as long as the bubble's blowing up. But as soon as the music stops, all the money in the world's not going to help you if you don't have another plan. And that's what I'm trying to think of is, what does that other plan look like? For me, it's buy a farm, build a wall around it, become an excellent shot, and acquire a vast arsenal of automatic weapons, feed my neighbors abundantly from my farm so that they are like, well, if one thing's certain, let's go over to James's place and help him protect the farm because that's our bread and butter. This is where I'm at in my thinking.
Right. No, I think just to get the conversation earlier, to make it tangible and not weird, make it about money, is if you're chasing the next hot stock or Bitcoin or whatever the next hot thing is, that's a short-term consequence of, oh yeah, I'm getting in. Even you dismiss reality, you dismiss valuation, so on and so forth. And that's what I urge against people doing, because then you throw caution at the wind and it usually ends badly. So just to make it tangible for people. Now, with your point about what do you do going forward, look, nobody knows what's going to happen. We've heard the doom and gloom scenario unfold since the first person ever came around centuries ago. But the reality has been things have been okay, or things have been good for the most part. Now, I do recommend people take a portion of their portfolios and allocate them to quote unquote safer longer term investments that are going to do well when the inevitable crash comes in the stock market. And that could be gold, that could be bonds, that could be commodities, by the way, they're not correlated as much with the S&P, so on and so forth. So if you're able to look at your portfolios and make sure that they're properly diversified, not diversified, meaning not too much diversity, but they're properly diversified. So if the stock market goes down a little bit, or if you've allocated to Bitcoin, if you've allocated whatever the case, the next hot stock du jour is, your other parts of your portfolio can go up and make sure that they're protected and they're real tangible assets. And that's how I would answer your question of how I would make sure the portfolio is properly protected and everybody's safe. Now, that's trading and that's investing. To answer the other side of it with Main Street, like have a farm and, build a wall and so on and so forth, I'll leave that up to each person to decide for themselves.
Okay, that's great, Adam. A very interesting conversation. I really enjoyed it. Thank you very much for joining us today, and we'll talk to you next week at the roundtable.
Likewise. Thanks, James. Take care.
Bye-bye.